The Minister said, and I'm summarising here, green shoots do not yet make a salad. And we've got to ensure that there aren't frosts that kill off the lettuce, right? And so we're going to get the Chief Forecaster and Director at Infometrics, Gareth Kiernan, to read the economic tea leaves for us, to tell us how robust those green shoots are. So please welcome Gareth Kiernan.
Thanks very much, Nadine, and also thank you to the Property Council team and Leonie for the opportunity to present today. I've now heard the phrase green shoots, I think, 7 times since I arrived, so I'm going to avoid that phrase myself and maybe talk about bright spots. There's a few of them out there, but as some of the other comments have hinted, not necessarily quite as I guess, flourishing as we might like at this stage. I mean, it's been a rough year. To be honest, it's been a rough 3 years. And increasingly hard as an economist to go around and talk to people and say, you know what, it's still not getting better. So I'm glad that I can come at a time when there are actually a few bits of good news coming through. So shaking off what we've had in 2025 and 2024 and 2023 as well, I want to start off by talking about interest rates. Now, if you go back to this time last year, early 2025, economists such as ourselves were looking at the numbers and going, by the end of this year, by the end of 2025, households will be having billions of dollars more in their pockets than they had at the start of the year because mortgage rates will have come down, they will have refixed, and they will be happy to get out spending again. Now, we all know at this point in time that hasn't happened, and indeed the Reserve Bank themselves have talked about how they've been surprised that the economy and interest rate sensitive parts of the economy, such as the housing market, have not responded particularly to the interest rate cuts that have occurred so far. To the point, of course, where if I went back 12 months, we would have been saying the bottom for the official cash rate was about 3%. Here's our latest forecast. So we've got the OCR currently at 2.5% and almost guaranteed another cut later this month, taking it down to 2.25%. Financial markets at the moment are looking at the sort of prospects for New Zealand and the sort of Reserve Bank signalling and saying, well, we think there's maybe a sort of 2/3 chance that potentially when we get to February there's room for another cut, taking the OCR down to 2%. That's not our central forecast at the moment. It is a downside risk in terms of lower interest rates coming through. But we think, give it another 3 months, because it is 3 months until the next review after this month's one, that the Reserve Bank will be getting enough signs coming through that they'll say, okay, we think we've done enough, the economy is starting to show more momentum, and bearing in mind that any interest rate cuts that are enacted now are going to take another 12 months to actually fully flow through and boost the economy. So even the rate cuts that were coming through the middle of this year are still not going to fully impact in terms of how the economy performs until the middle of 2026. And so increasingly what we're seeing is financial markets, sure, there's room for maybe another cut, maybe another 2 cuts, but they're also starting to turn their attention to when do interest rates start to rise again, and how quickly do they go up, how far and how quickly. And so our forecast at the moment is that by the end of 2026, we'll get to a point where the economic growth has built, the economy has momentum, and the Reserve Bank needs to start moving that official cash rate back up from 2 or 2.25%, back up towards something neutral, where it's not stimulating the economy, but it's also not pressing the brakes. So we think that by the middle of 2027, you've got the OCR back at 3% and everything's roughly in some kind of nice balance. We're also aware that that those balances don't often happen with the economy, and it tends to go in one direction and the other. And so you can see with the graph there that we do have upside risks as well in terms of where we expect interest rates to go beyond the middle of next year. Middle of 2027, potentially getting as high as 4%. And one of the most hotly debated areas in terms of our forecasting team at the moment is what is going to happen to inflation. So the next graph here has a lot of lines on it. I'm not going to explain all of them to you, but the orange line is headline inflation. That's the number that Stats NZ publish, and it's currently sitting at 3%. All the other lines on that graph are technical measures of inflation that we as economists look at and try and ascertain what is going on underneath that headline number. Take yourself back to mid-2021. At that point in time, the Reserve Bank was telling you that inflation, the pickup in inflation we were seeing, was going to be temporary. If we'd looked at all those sort of technical measures, though, you can see all of those lines are pointing at that stage very much upwards, with increasing sort of, or varying degrees of sort of steepness of those lines. And it was pretty clear to us at that stage that conditions needed to tighten, there needed to be the brake pedals pushed on the economy because inflation was actually building substantially. Contrast that with at the moment where, sure, headline inflation has popped back up to 3%. But when we look beyond, we look at those technical measures, some of them are lifting a little bit, some of them are still actually trending downwards. Suggests to us that underneath the headline number, there's not a lot of widespread pressure. And when you decompose the numbers a little bit more, sure, you've got the stuff that really catches people's attention: food, electricity, local government rates, insurance costs. Those have all been rising substantially. And of course, households are feeling the sort of cost of living pressures. Not as bad as they were 3 years ago, but nevertheless, those are the sort of things that you can't avoid spending money on. You have to pay for them. And so there is still that sort of squeeze on discretionary spending through the economy because of what we've got with inflation at the moment. But there is good news. Food price inflation in September slowed from 5% to 4.1%, so just signs that those butter prices, and if any journalist rings me up again about butter, I'll just hang up on them because I'm tired of it. Over the last 3 months, they all want to talk about where butter prices are going next. Mince is the new butter, apparently, as well. Rates, up 9% this year, but they're up 12% last year, so 9% isn't great, but it's better than 12%, right? Even house insurance costs as well, they were running up at 25% per annum a couple of years ago. They have slowed in the latest quarter, down from 10% to 5.6%. So there are signs that even those pockets of pressure that are causing stress and problems for households are starting to ease as well. The question then becomes, if inflation is moderating over the next 12 months or so, back down towards 2%, what about beyond that as the economy starts to grow more quickly? And that is still a bit of a concern for us. Inflation expectations are still reasonably elevated, and we know that it's potentially easy for the economy and businesses to slip back into starting to push prices up again. But our central forecast is for inflation to remain subdued, with interest rates pushing back to 3% rather than the 4% you see there. But keep an eye on some of those demand pressures over the next 12 to 18 months. Now, you were told, I think, back middle to late last year that you needed to survive until 2025, as Nadine referenced earlier. In fact, if you go back another 6 or 12 months, you were told you were going to be thriving in 2025, which was plainly wrong. So why believe us as economists now that actually things are getting better? Well, let me pull out some of the numbers for you. This first graph is not going to convince you particularly. This is monthly spending activity on electronic cards. You can see the lockdown in 2021, the big hole there. But you can see also from early 2023 through to mid-2024, monthly spending activity, and this is the value of spending, so bear in mind that inflation was running at up to 4 or 5, 7% at times. The value of spending on a month-by-month basis was tracking lower over that 18-month period. We hit July last year, and things started to turn a corner, so it seemed. And by the end of the year, we had spending, it was up more than 4% from where it had been in mid-2024. And we thought, this is nice. Don't quite know what's driving it. There were tax cuts, small tax cuts, but maybe they helped. Too early for interest rates, we thought. We got some more data through, and it turned out that it was very much tourism-driven. And don't get me wrong, tourists are important, as the Minister has been talking about, but in terms of that sustainable growth coming out of New Zealand is actually getting out and being willing to spend more. It wasn't there. And so what we've seen through the first half of this year is that sort of spending growth, it dissipated, and we lost roughly 3/4 of the gains we'd made through the second half of last year. But if you look at the latest data again, over the last 3 months up into August, sales activity back up by about 1.5% over that 3-month period. A little softer in September, but it's only 1 month. I'm not going to worry too much about that at this stage. Just signs that, again, maybe we're starting to see a little more activity coming through, and we're hopeful that it is more sort of New Zealand interest rate driven coming through in terms of boosting that. The Minister talked at the end, one of the questions there about, as a mortgage holder, she's not going to rush out and spend the $400 a week or a fortnight that she gets back in her pocket immediately as she refixes her mortgage. And that's a fair comment. But Adding to the sort of layers of household caution that we've seen through the course of this year has been the way that the labour market has been performing. You know, if you're not certain about what your job security is like, what your income security is like, you've been burnt, of course, with very high interest rates over the last few years as well, you are going to be careful with your spending. The best news, though, around the labour market that we're getting, we had last week unemployment rate pushed higher to 5.3%. That was as forecast. But we are getting some other numbers through just suggesting that we are in the early stages of a turning point for the labour market now. This graph here shows you job numbers on a month-by-month basis. Don't worry too much about the number on the left-hand side. It's a scale, but it's set so that 2019 ad levels, because 2019 was the last normal year before the world sort of imploded, 2019 ad levels are set at 100. So at the moment, when you look at the line, we're sitting at about 70. We're about 30% below where ad numbers were in 2019. What you can see over the last sort of 18 months is, though, from May 2024 through to about July this year, ad numbers tracking sideways, up one month, down the next with monotonous regularity. No signs of any improvement being sustained there. But the last 3 months, what we have seen, you have to look closely at the graph to see it, but the last 3 months we've had 3 months of increase in a row. So job numbers have lifted by about, job ad numbers have lifted by about 6%. Is this, we're hopeful it is it these sort of signs that the business confidence that's been strong for the last 15 to 18 months, the employment intentions that have been strong through that period as well, is it finally starting to translate through into a bit more hiring activity? When we look at monthly job numbers, we've seen those over the last few months as well. 3 of the last 4 months, they have increased. And again, the lift has not been particularly large. It's only up 0.4%, but it's heading in the right direction after a year of tracking sideways, and before that, a year to 18 months, pretty similar to job ads, of falling through 23 and 24 as well. So just signs there that hopefully there's a bit more coming through in terms of employment activity. You might not feel it, though, if you're up in Auckland at the moment, if that's where your business is based. This map here shows you where that job growth has been strongest. So this is September quarter this year versus job numbers a year ago. And it's pretty obvious when you look at that where the action is being felt most strongly, down in the South Island. And that corresponds with a key part of the economic recovery that I haven't mentioned yet, and that is the agricultural sector and strong export prices flowing through and stimulating demand and activity across provincial economies. And the presence of that agricultural sector is larger as a proportion of the economy. It's more important in the South Island. You also add in the international tourism recovery that has been occurring as well, and we are seeing the effects of that in the likes of Canterbury and Otago. So that South Island performance is heartening. That money is starting to flow through into business activity and ultimately hiring activity as well. If you look in the North Island, as I said, Auckland struggling, Wellington struggling. There are other parts of the sort of provincial parts of the North Island that are not doing quite so well. It is interesting when you look at Waikato and Bay of Plenty, though, that although job numbers haven't really started to lift there yet, they are still less negative than in other parts, sort of some other parts of the country as well. And that does reflect the strength of dairy prices. It reflects the strength of horticulture and kiwi fruit prices as well, just flowing through and starting to boost activity in those economies. So where does the labour market go to from here? I mentioned the unemployment rate currently at 5.3%. We think by the end of next year it will have come down to around about 4.6%. Most forecasters are between 4.5% and 5% by the end of next year. So there is a consistent theme in expectation that labour market conditions do improve through that period, and sort of ripples through from those provincial areas and starts to impact more positively on some of the urban areas as well. Final sort of area I want to look at is just around the housing market. And this is kind of the elephant in the room, really, for us, because the housing market at the moment is still pretty soft. When you look at stock numbers, the number of properties available to purchase on realestate.co.nz at the moment is at its highest in 10 years, and it's been sort of steady for about 9 to 12 months, but it's just started pushing higher again. So from a buyer perspective, there's a hell of a lot to choose from. Sales activity, if anything, over the last couple of months has weakened. weakened, and it's back at its lowest level since January. And when you look at lending data from the Reserve Bank, it suggests that the sort of first-home buyers are going okay, investors are going okay, but the pool that's missing are people, other owner-occupiers, about three-quarters of the market, so trading up to a bigger home. There's not that sort of turnover coming through in the market at the moment. In terms of where that sort of stock numbers and where the market is weakest, it's areas concentrated around those urban areas, Wellington, Wairarapa, Auckland, Coromandel showing through, particularly in terms of some of those figures. Interest rates are becoming more positive, and as I said, the Reserve Bank is also becoming more beneficial for the market, becoming lower. And the Reserve Bank has been surprised how that hasn't impacted and driven the housing market and a bit more momentum coming through there. But they are running up against weaker net migration, which shows through heavily in this graph of population growth. Back in late 2023, we had net migration sitting at 136,000 for the year. The latest data shows the net inflow of people over the year to, I think it's July or August, 11,000 people. So down from 136,000 to 11,000. And you can see that big slowdown in population growth that has occurred. It's quite surprising when you look at the foreign arrival numbers. They have come back down, but they are still at higher levels than we had back through the second half of last decade when we thought that immigration was incredibly strong. I'm not quite sure what all these people are doing when they arrive here because the labour market, as I've told you, is reasonably weak. There's not demand from businesses for them, but they are coming in. Work visa numbers are high as well. Where the change has come from the second half of last decade, though, in terms of that population growth, is the number of Kiwis leaving. You look at the outflow of people to Australia, it's sitting around 30,000 over the last year, and it does reflect that Australia's unemployment rate is 4.3%, ours is 5.3%. So the grass is greener on the other side of the Tasman. You go back 7 or 8 years, Australia's unemployment rate was close to a percentage point higher than ours. So that sort of has reversed, and it has had a massive impact in terms of that population growth. And if you're not getting migration, if you're not getting population growth, then that does limit the sort of fundamental demand within the housing market, and it flows through into residential construction activity as well. You can see going forward, we do think migration stabilises, stays in positive territory, but you're still talking about population growth that potentially, apart from the lockdown through the pandemic in 2021, slowest population growth potentially since the mid-1980s. So if the housing market isn't going great and you haven't got that fundamental demand, how does it impact on household spending? My final graph here shows you, on one axis, private consumption growth, that's household spending, the economist's name for it. On the other graph, you've got house price inflation. And you look at that graph from 2000 through to about 2016, 2017, and I can tell you, as an economist, you don't get too many graphs where the lines match up better than that. It was quite remarkable when I put it together. Since then, the lines have sort of drifted apart a little bit, but the sort of message is clear. There is a correlation. I'm not going to say a causation, but there is definitely a correlation between household spending and what happens with the housing market. You can see the challenge going forward is we're not expecting house prices to rise particularly, and in fact, in real terms, they may still be drifting a bit lower. So how do we get household spending growth occurring going forward? Can it happen without the housing market booming as well? Now, the Prime Minister, of course, has said that he wants moderate, consistent increases in house prices. Sorry, modest, not moderate. It kind of communicates to me that he can't envisage a world where the housing market isn't performing well and the economy is performing well. He thinks they go hand in hand. But my message would be, if you go back prior to the mid-1990s, I think you see economic cycles in New Zealand that are much more like what we're looking at the moment. From the mid-1990s onwards, our economic cycles have been largely driven by migration and those sort of population inflows, which have driven the housing market, they've driven the Auckland economy, and that's ultimately flowed through and sort of radiated out across the rest of New Zealand. Before that, our economy, our cycles were largely driven by what happened with export prices. When farmers were doing well, that would flow through provincial economies and ultimately flow through and stimulate economic activity in the urban areas as well. So the message is, this looks to me much more like a sort of pre-1990s New Zealand economic cycle than one that we've seen over the last 30 years. And so there is opportunity, we believe, for the housing market to remain reasonably stagnant, given that housing affordability is still poor, but for our spending activity to pick up as well. One or two concluding thoughts, and then I'm happy to take questions for you. Labour market, it is a key in terms of that emerging recovery. I've bolded, in this bullet point, I've bolded the word upside because it's been a hell of a long time as an economist since I've been able to talk about upside risks. I've talked about the effects of interest rates. We've also got a lot more infrastructure spending coming from the government as well, which will potentially help to boost more economic activity through 2026. I was talking to Mike Hosking a few weeks ago, and he said, "Are you talking about risks of overheating in a 12 or 18 months' time?" He said, "I'll take that. That's after the last 3 years, I'd rather take those risks than the sort of crap we've had to deal with through the last few years." As I said, housing, it is still a challenge, and can it go without, or can it go sideways while consumers lift their spending? Hopefully. I haven't talked about global events. It's not really time. There might be questions, but particularly in terms of that Chinese-US tariff situation, keep an eye on that because China is our largest export market. So where does that settle down? And we are also keeping a close eye on some of these export commodity prices. They have been strong, just a little bit of weakening over the last few months in terms of dairy and pork prices. They're still 20% above their sort of decade averages, so still good, but just little risks starting to come in there that could undermine that agricultural recovery, but it's good for now. All right, thanks Nadine. We've got questions.
Stay there so we can hear you. I think we've got a new contender for quote of the day already. Mince is the new butter. I like that, Gareth. How much are the increases to the likes of insurance and rates offsetting the boost to household budgets from lower interest rates?
Yeah, I haven't done the maths around that entirely. I don't think it's entirely offsetting it because I think there is also evidence coming through in the numbers we're seeing and sort of the anecdotes alongside that people are either keeping their mortgage payments at the same, so reducing their debt faster because they're like, well, I can live on the money I've had, generally speaking, or they're sort of saving for a bit of a rainy day in case things turn pear-shaped in the economy or the job market or whatever it might be, given the experience of the last few years. So I don't think you can completely blame some of those cost increases for the lack of spending growth elsewhere.
The top-rated question at the moment is what early indicators should retailers watch to anticipate turning points in household confidence or discretionary spending?
Yeah, that's a good question. Look, we are watching those job ad numbers and the sort of monthly job numbers published by Stats NZ because we have been talking about the labour market as a key for probably a year in terms of that being the last sort of piece in the puzzle in terms of boosting that confidence. I talked about the strength of business confidence over the last 18 months. We haven't seen that to anywhere near the same degree in consumer confidence. So there is scope for that particular indicator to lift as well. But it's kind of one of those things, as an economist, you guys on the ground, if you're actually working in retail, you're probably going to see some of the signs of it almost before us, because we look at the data and it takes a little while to come through. I say to businesses that I work with and advise, you can tell me about the next 3 to 6 months better than I can probably tell you about the next 3 to 6 months. It's some of those longer term issues and risks and trends that I want to throw at you and say, just keep this in mind in terms of where things are going.
Do you have a sense of what Labor's proposed capital gains tax would do to the economy?
I think, look, in the short term, I mentioned investors. I think in the housing market in particular, if you're a potential investor in the housing market, you're not going to be rushing back in there at the moment with the polls as close as they are and the threat of any capital gains that you get after 2027 being taxed and reducing your overall return from the property. So I think from a housing market perspective, even, just the talk for the policy hanging over it, that does just potentially limit that housing market recovery, adds another layer to that as well. Beyond that, look, one of the things that's frustrated me actually about the capital gains discussion over the last decade or longer is that every time it comes up, it's talked about as a new tax, even from Labor, who are, the ones who tend to be pushing it. Whereas if they were talking about it as, it's this tax here, we're making things fairer by taxing this untaxed income over here, and there's going to be tax cuts elsewhere, and 80% of the population or the taxpayers are going to be better off because they're paying less sort of PAYE income tax, that sort of thing. I would love that as an economist because it is an inherently unfair situation the way it's approached at the moment. But Lo and behold, they announce it, and what are they doing? They're just spending more of your money. I'm showing my true political colours there. But yeah, look, don't get me wrong. Free doctor's visits for people, there's a portion of the population who that is important for. It's not important for me. I don't need 3 free doctor's visits, and any young person probably doesn't need 3 free doctor's visits either. So that's probably my frustration, is that it's a sort of ongoing push towards big government. I know also there's been talk about the inclusion of commercial property within it as well. I suspect it's probably less of an issue there in terms of the changes, because as a company in that space, you're going to be having to pay tax on your profits anyway. But nevertheless, it does have the potential for a bit of disruption through that part of the property market too.
We would have seen, most people would have seen the data about the number of small packages coming into the country from Shein and Temu and the like, so this question is quite relevant in that context. How are shifting consumer habits and online spending trends influencing the pace of recovery across retail?
Yeah, and look, New Zealanders always love a bargain, right? But no more so than when the purse strings are tight and you want to buy something and it's $20 down at the local shop and you can get it for 50 cents off Temu or wherever. And if it breaks in a year, you just go and buy another one, right? So yeah, look, we have seen big increases in that sort of trend of packages coming in. Stats NZ has revised their data a little bit over the last 6 months and down-weighted how much they think is actually coming in. They've got better methodology. But nevertheless, from a retail perspective, that money is being lost overseas, right? Otherwise, it would have been spent here to some degree, because remember, people would have been paying more for it. So yes, you're sustaining jobs, but there's still a lower volume of spending that would have been able to occur if the money was being spent within New Zealand. But nevertheless, look, that online it's a real challenge, and it has been for some time for the retail sector. I know prior to COVID, there was a lot of talk about experiential retailing, people coming into stores for things you can't buy online, or coming in for the sort of almost luxury experience and the advice and all that sort of thing that you don't necessarily get there. So it's something that can be not overcome but worked against, and the sort of I guess that sort of physical retail offering does still have an important role to play as well.
We've got 30 seconds left. I'm going to attempt to squeak one more in. Are the current government policies striking the right balance between curbing inflation and supporting business growth?
Yeah, that's it. Look, I think National could have been much more austere, and I don't like the word austerity being applied to the current government, because they could have slashed and burned a whole lot more. It's tough in Wellington, don't get me wrong, in terms of job cuts, in terms of spending cuts, those have been massive. But I think there is actually a reasonable balance in terms of going, we're going to get back to a surplus in 5 years' time, not in 2 years' time. And when you look at the the sheer magnitude of the spending growth that had occurred, even prior to COVID, but through COVID as well, something had to be done. It was not sustainable. So yeah, overall, I think the balance is reasonable, but don't get me wrong, it hurts like hell while it's happening.
Please put your hands together for Gareth Kiernan from Infometrics. Thank you, Gareth.